Hi, I'm James Robinson, and this is my stock thought of the week. Today we're going to continue our series on how to diagnose good companies, what we look for when we're looking at a company's financial statements. Today we're going to start with what is revenue and why revenue isn't as important as you might think it is as a diagnostic tool, what you can't tell from revenue, what you can tell from revenue, and what I try and learn when I look at a company's revenue. So what is revenue? Revenue is an accounting term, and it's the total amount of money that a business collects from selling its goods or services. So this is just all of the money that comes in. When you sell a Snicker bar for $4, you have $4 of revenue. It doesn't matter what it costs to buy the Snicker bar. Doesn't matter what it costs to, run the store, to pay for utilities. It's simply the total amount of money that you charge your customers. It is also called the top line. It's the top line in the income statement. It's sometimes called sales and sometimes called turnover. All of those terms are interchangeable for revenue. It also tells you how big the business is, right? If a company has $1 billion in revenue, that's a bigger business than a company that has $500 million in revenue. It's always calculated over a set period of time. Typically, that period of time is annually, quarterly, or monthly, but it could be any period. They could just pick two random dates and say, between these two dates, here's how much money we had in revenue. But you'll always see a quarterly statement for a financial statement that has the revenue that was earned that quarter. You'll also see in an annual report what was done for the year. And oftentimes internally, a company will look at how much they made in a given month. So again, in short, revenue is how much money your clients or customers paid you over the period of time in question. Wall Street tends to think revenue is really important. That's because in large part, Wall Street is very short-term oriented, and they are simply looking at finding something to report to their customers, even if what they're reporting might not be very important. So Wall Street will say, hey, revenue is up 7.2% this quarter, for example. The problem is that revenue is not in any good way a predictor of what's going to happen. It is, therefore, I think, of very little diagnostic value. Revenue can tell you what did happen, but I don't think it gives you much sense of what's going to happen next. So the company's revenues are up 7% last quarter. Wonderful. What's going to happen next quarter? I don't know. We don't know enough about the business by just looking at revenue to decide if that number is meaningful. Short-term revenue is something you should be concerned about if you already own the stock. But it's not a primary concern when researching the stock and trying to decide if it's investable. So, and if you think about it, that makes sense. If I own the company and my fortunes are going to rise and fall with the fortunes of the company, then I do want to know how those companies' revenues are behaving last quarter and over the last year, for example. But when I'm looking at this as an investor and I haven't yet decided to invest in this company, there's a lot of other things that I look at and that I think are more important than revenue. So touching back on this issue that Wall Street is really, really concerned about revenue, they really do look for every quarter what the company reports in revenue, and they report it like it's really important. And in one sense it is, but I don't think it is in this greater scheme of things. You have to understand that there's a lot going on with revenue that might have nothing to do with how good a job that business or that management is doing. So one problem is that some businesses are seasonal. And if a business is seasonal, what happens quarter to quarter is almost irrelevant because there's typically one season where the company does exceptionally well and other seasons where the company does poorly. And so when you're comparing, for example, quarter to quarter, you don't learn much by learning that H&R Block, for example, didn't have a good fourth quarter, but they had a great third quarter. H&R Block bases all of their revenue around the months preceding tax time. And therefore, if you look at that quarter, they're going to have a tremendous amount of revenue. But if you look at it the next quarter when no one's filing the taxes, they have virtually no revenue. And so looking at it quarter to quarter for that business tells you nothing, and in fact gives you a negative picture of what's going on. So here are some examples of seasonal businesses. You can see Macy's, Target, and Best Buy. These are Christmas retailers, and the majority of their annual profit is earned in the fourth quarter. Now, when I say the fourth quarter, that might not be Macy's fourth quarter. Their reporting might be different. But the fourth quarter is generally determined to be the last quarter of the year, so it's October, November, and December as we go forward. H&R Block, as I talked about a minute ago, is a tax preparation. They almost earn all of their money in the first quarter, and they spend the rest of the year just basically trying to exist to make it back to the next one. Vail Resorts and Cedar Fair are ski resorts and theme parks. Obviously, Vail isn't doing much money in the summer. Cedar Fair isn't doing much revenue in the winter. Pool Corporation, Pool Supplies, it's almost entirely a spring and summer business. Hasbro and Mattel makes most of their money at Christmas. FedEx and UPS, again, shipping volumes dramatically increase in the fourth quarter as Christmas is coming. And Scotts Miracle-Gro is a lawn and garden company, and nobody buys fertilizer in November, I suppose, unless you're in Phoenix. So where I'm going with this is if you're looking at quarter-to-quarter examples, you can see there's all kinds of businesses that makes no sense. And even almost every business has some seasons that are better than others. And so that's a reason why you can't look at short-term revenue as being really, really important. Another problem is that some businesses are cyclical. With commodities, for example, a spike or drop in your firm's commodity price can dramatically spike or drop your earnings or your revenues. But nothing about the business has changed. So let me give you an example. Let's say you're an oil company and it's the first quarter of 2026, which was a few months ago. Oil was trading at about $65 a barrel, and your company made however much money it made on $65 a barrel oil. That would be their total revenue, the number of barrels you sold times $65 a barrel. Now, fast forward the tape, it's the second quarter. There's been a war in Iran. The Strait of Hormuz is closed down, and oil has jumped to $100 a barrel. Well, your company has just made a 50% increase in their revenue for the same amount of oil being changed. The management didn't do anything. There was no reduction in debt. There was nothing changed about your business. It's just very fortuitous for you that you get to charge more for the same commodity that you were selling a short time ago. Unfortunately, that same thing can happen in reverse, and the commodity price can drop dramatically. So even looking year to year with a commodity business in the short term, you oftentimes are getting false positives and false negatives for what's happening in the business, which is yet another reason why I don't think you should pay a tremendous amount of attention to the revenues for a company. So here are some examples of commodity businesses. So oil and gas. Prices are set by OPEC, geopolitics, and global demand. So revenue and earnings can swing 50% with no change in the business. Coal. Thermal coal is tied directly to electricity demand. Metallurgical coal is tied to steel. Both driven by forces outside of management's control. Home building, entirely tied to interest rates and consumer confidence. Shipping and freight, container rates can go from $2,000 a container to $20,000 during COVID, for example, and then back. Auto manufacturing, this is the first thing consumers defer in a recession. It's also tied to credit availability and interest rates. Chemical companies, again, input costs and end market demand move independently, and margins get crushed when they diverge. And we could go through all of these, but you can pause this video and watch it on your own time. But these are just examples of businesses that are very cyclical and that looking at quarterly or even annual revenues don't tell you if the business is well run or poorly run. Here's a chart for a company that I own as of today. It's a company called EOG. They're an oil company. And you can see in 2022, the price of oil had gone to $109 a barrel. On about 475,000 barrels, they made $7.41 billion. Jump forward 2 years to Q3 2024, and oil's at $76 a barrel, and they made $5.9 billion for about the same production. Fast forward the tape to a few months ago, and Q2 2025, I guess that's a year ago, and revenue is $5.4 billion on, again, about 500,000 barrels made. And then if you jump to this quarter, which hasn't come out yet, as I do this, which is April of 2026, you'll see that oil prices are around $100 a barrel, and revenues will be up around $7 billion for the quarter. So you can see these dramatic changes in revenue, EOG is a wonderful business. It's strong in every way imaginable, and yet they have this 50% swing in revenues through no fault of and through no genius of the management. Another problem with looking at revenue is that oftentimes companies perform much better at different points during the business cycle. It may be that the company you're researching is excellent in every way, but if it's a home builder, it isn't going to record numbers, isn't going to have record numbers and have even good numbers in a market contraction. In the same example, your home builder might have record results early in a recovery because that's when home builders tend to perform very well. Since every industry is different, there's a lot to keep track of when looking at quarterly revenue. If this is a seasonal business in the wrong season, is it a commodity business whose commodity is in the wrong part of the pricing cycle? Or is it a business that is harmed by where we are in the business cycle? That's a lot to keep track of, and there's a lot of filters to run through as you're trying to decide if revenue is important. And so I think it's easier just to decide short-term revenue isn't important at all, not because it isn't important, but because it doesn't have any diagnostic value. It doesn't tell you very much, and the amount of additional information you need to have to decipher it just makes it not worth the trouble. So I really am looking at revenue through a very, very tight prism. So here you can see examples of companies, going back to the issue of the business cycle. You can see examples of companies that perform well or poorly in various parts of the cycle. So in an expansion, Caterpillar, Marriott Hotels, Home Depot, and Ford, those companies all do very well because people in an expansion are, for example, investing in new equipment for Caterpillar or buying new cars for Ford. Peak or late in the cycle, often energy companies are doing well. Companies that are commodity companies are doing very well because the business is red hot and everything is blowing and going, and so we need more fuel. Raytheon and Lockheed Martin, Defense Department budgets often lag and spending peaks later in the cycle, so they might not do as well. In a contraction, Walmart and Dollar General do better because people have stopped shopping at Louis Vuitton because things are getting tight, they're tightening their belt, and so they'll go back to Walmart. H&R Block, it might be in the contraction that people will not pay their accountant to do their taxes. They'll take them to H&R Block to do them instead. Altria tends to do pretty well in a contraction because people don't stop smoking just because the economy's gotten tighter. And then in a recovery, regional banks, airlines, Visa and MasterCard all do well. Visa and MasterCard, for example, because people start spending money again. So that gives you sort of a breakdown again of how the cycle might affect the company that you're looking at. In addition to all of that, there are things that are idiosyncratic to the business itself that can dramatically affect revenues. So, for example, take a movie company, a movie business. They can have a blockbuster movie or a bust in any given quarter. If they have a blockbuster that they hadn't had in previous years in that quarter, then that quarter is going to look spectacular. By the same token, if they make a movie that nobody wants to go see, then they're going to have a bad quarter. And so how do you value the movie company if you're looking at quarterly results when those quarterly results don't really tell you how good for example, the library of movies are that the company has from the past, what projects they have in production that might be home runs going forward. You don't know enough to be able to determine what's idiosyncratic about that business. Another example is Boeing. Boeing might deliver 12 planes in a quarter or 40, often for reasons that are completely justified, production schedules, certification delays, supply chain holds, etc. And so there are a lot of businesses that have nothing to do with the business cycle and have nothing to do with seasonality and have nothing to do with cyclicality that can just have really good or really bad quarters, which again makes it really hard for us as the investor to decipher what's really happening there. And if we have to spend the time to go and decipher it, well, what is the point of the information in the first place? And in this slide, again, you can see examples of companies that have idiosyncratic revenue swings. Boeing, pharmaceutical companies, did they come up with a great new drug? Did they get turned down for a drug? Lockheed, Raytheon, again, large government contracts get let, they're going to do very well. Movie studios, Apple, every September they have a new launch. If that launch is really exciting and everybody likes the new iPhone, Apple's going to do great. If they don't like the new iPhone, Apple's not going to do as well. So these are just examples of companies that have these idiosyncratic swings. So the point of all this is to basically let you know that short-term revenue can and does tell you what happened in the business, but it doesn't tell you much about the business itself. It doesn't tell you, is this business performing well? Is it not performing well? Is it dealing with headwinds or tailwinds? A commodity business, for example, an oil company, when the price of oil during this Iranian war goes to $100 a barrel, your oil company looks like it's the hottest software company in the world. It's just printing money. And yet if that oil price drops down to $65 a barrel, that same company might look like a failing buggy whip manufacturer. And in neither case is that true. The business is as solid as the business is. It's just massively affected by the price of the commodity. And all of these examples that I'm giving are trying to illustrate that point. So when you're looking at a business and you own the stock, you do want to look at revenues, but you don't want to look too closely. You don't really care about a 5% swing one way or the other in the revenue of a company. That just naturally occurs in a business. A great business can have a down quarter. And as a long-term value investor, you need to get past that. You need to get over that and just say, of course, that's going to happen sometimes. What you're looking for is aberrations. What you're looking for is enormous swings that are big enough that you need to figure out what happened in the business. And a 3% down quarter, I mean, telling you, it's almost nothing. Who cares? A 15 or 20% reduction in revenue for a quarter relative to last year, relative to past years. Well, now you want to start doing some research. Read the quarterly report, read what's happening in the industry, see if your company is the only company having that change in revenue or if it's industry-wide, and just try and get a sense for what's happening. So a good litmus test that I use when I'm looking at revenues, whether they're good or bad, is whether it's something that's good or bad for the stock, which means it's going to make the stock price go up and down, or whether it's something that is good or bad for the business. So the business is different than the stock. The stock is going to adjust and go up or down marginally for the short term, get a bounce, for example, out of a slightly higher revenue, but probably nothing changed with the business. On the other hand, if there's some major change, there is some aberration, and you can say, wow, something's really gone on with this business. An example is Intel. A few years ago, Apple switched from Intel chips to making their own chips, and that was a big hit to Intel. Now, as a shareholder of Intel at the time, I would have said, wait a minute, this is a big change. This is something I need to really think about. Do I still want to own Intel? Because they've just lost one of their biggest customers, and the biggest customer is now not only making their own chips, but they're making better chips than Intel, and that would be a giant red flag. So that's what you're looking for. You're looking for aberrations, and you're looking for aberrations that define a change, some kind of change in the quality of the business, good or bad, versus something that's going to affect the stock for a few days and then be forgotten. This chapter is longer than it needs to be. I could have done it in one page. I could have simply said, when you're looking at a company's revenues, you want to look at least 10 years in the past, and you want to ask yourself, it's going to be in one of three patterns. Is the revenue generally up? In which case, you give the stock a rating of 3 or 4 on a scale of 1 to 4, and you say, great, on to the next issue about this company. Is it generally down? In which case, you give it a 1, and you basically are done looking at the company. Because if a company over 10 years hasn't had their earnings turn around, or the revenues turn around rather, then it's unlikely to happen. And we can't be all things to all people. We're not venture capitalists, and we're not turnaround artists. We're looking for solid companies at a fair price. Solid companies don't have declining revenues. The third thing they might do is they might go up and down over a 10-year period of time. And when that happens, that basically, all that's telling you is this is a commodity-driven business. And once you know it's a commodity-driven business, then it's not going to fall into the category of a generally acceptable or generally desirable value business, value investor business. But that doesn't mean it's not buyable. We're going to have a chapter in the book, or I'm going to do a video where we talk about what to look for when buying commodity businesses, because you can make money in a commodity business, but there's certain things that need to be there for that to happen. And we'll wait till we get to the commodity chapter of these videos to go through that. So if you look at companies over the long term, then you will see there are some companies who have generally declining revenues. They might actually be okay businesses, but there's thousands of public companies out there, and I don't need to find the 5'6" point guard who happens to be able to shoot and handle the ball well. I'm looking for 7-footers where I don't have to be a genius. And there are enough 7-footers out there that I don't need to be buying bad companies or companies that might be turning around. And I'll give you an example. On this list is a company called Macy's, and Macy's is actually a pretty well-run department store. They have they've increased their dividend. They buy back stock. They've done a great job of paying down debt. They've got, they're trying to control their inventory, but they're in a horrible industry. They're a department store, and no matter how well run they are, they're still a department store, and that's not an industry that's very sexy or profitable in 2026. But these are other examples you can see here of companies that are generally declining in revenue, and all of these companies to me are uninvestable. Again, another potential example is IBM, which has had about 10 years of declining revenues, but for the last 4 or 5 years has started to turn around. And so you might consider that. But long story short, if the revenue is declining, it's out. One other thing to consider when you're looking at revenue is that it's very, very specific to the business in question. It doesn't afford you the ability to compare two different businesses in the same industry, nor does it give you the ability to compare different businesses in different industries. So when you look at gross margins, a 45% gross margin is a great gross margin, and it doesn't really matter whether it's a software company or whether it's an automaker, for example, although they typically don't have 45% revenue or 45% gross margins. But a high gross margin company can be compared to every other company in the industry, and you can simply say, of the oil manufacturers, which companies have the best gross margins, that's the one I want to buy. But you can't do that with revenue, because one company's revenue might be $50 billion and the other one might be $50 million. And the $50 million business might be far better run. And so, again, it doesn't tell you much about the business revenues, and they don't give you an opportunity to compare businesses against each other, which is another thing that you want to do as you're looking at investing. So here's a revenue chart for a company that I think is an excellent company, one of the best companies out there. It's called Snap-on Tools, symbol is SNA. And you can see here that the revenue just gradually goes up every year. There's been a couple of flat periods. In fact, the last 2 years have been relatively flat, much to my chagrin. But long story short, the company is growing its revenue pretty traditionally, pretty steadily, pretty predictably. And if that company is doing that, and they're doing a good job of taking care of shareholders, and they don't have a lot of debt, that's a company that's got a pretty good chance of being a good investment in the long run. Again, this is the first step in the research. You've got a lot more homework to do, but this is one that I'm excited to do the homework when I see this slide versus, for example, the next slide we're going to see. So this slide is the slide for Macy's, and it's gradually going down over a long period of time. And as I said earlier in the video, I think Macy's is actually a pretty well-run company. It's just in a horrible industry. And do I really want to buy a company that is having their revenue decline year after year after year? That's swimming upstream. Why do I need to swim upstream when I can swim downstream? And so this company, I would do the rest of the research on Macy's, and I have, but I knew almost at the instant that I looked at this slide that I wasn't going to buy it. I did the research because I wanted to be familiar with all of the businesses in this industry. And so I had to do that research, but I knew very quickly that this was almost certainly not a stock I was going to buy, and it gets a 1 in this category. And I want to point out also, this isn't a dramatic decline. It's not down 10% a year or anything, but just the fact that it's never going back up and it's always going down means you're always fighting an uphill battle. And I just don't want to do that with my investments. I think this slide is the most telling and the most interesting of any slide in this presentation. What we're looking at here are two oil companies. One of them is best in breed. It has no debt. It buys back stock. It pays a nice dividend. It's extremely well run, one of the lowest cost of production in the industry. It's a company that I own in my portfolio. And the other one is a horrible company that I have no interest in buying under any conditions. And in looking at this chart, you can't tell them apart. It's not possible for you to tell me which of these two companies is the better company. And the reason for that is because they both sell oil. And in the good times, they both look great. And in the bad times, they both will have these drops. And so you don't really know anything about what's going on with these two businesses by looking at this slide. And once you recognize that that's the case, that you haven't learned anything by looking at these two slides, you'll have a sense for why I think revenue is not a great diagnostic tool for determining if a business is a great business. What we're looking at for the revenue is one of three things. In the long term, is it gradually going up, or better than gradually going up, basically going up at least? Is it gradually or worse going down? If it's going up, it's a buy. At least it's going to pass that first filter. If it's going down, it's not a buy. There's no reason to look any further. And the third one is it going up and down over time? Well, now we know it's a commodity business. That gets put into a different bucket for is it the kind of commodity business we'd like to buy? And so hopefully this illustrates what's going on here with revenues, or at least what's going on with revenues, the way I philosophically look at it. So that's it for revenues. Thank you very much for your time.